Let us assume that you want to start a new bicycle manufacturing plant in India and you're thrilled about it because you believe that it's going to be a cash cow. However, your rational mind instructs you to conduct a quick investment analysis to determine whether you will be able to recover your investments or not. And that is when the discounted payback period comes in handy. Along with other corporate finance tools such as the net present value and internal rate of return, you can utilize this discounted payback period to determine how quickly you will be able to recover your investments. Hi all, my name is Dheeraj Vaidya from WallStreetMojo.com, and in today's video, we'll discuss all about discounted payback period, its calculations, how it is used in project evaluations, and its limitations. So let's get started. So first thing first, before we even talk about this discounted payback period, you must be aware of what is a payback period, right? Because discounted payback period will get built upon what is a payback period. All right. So those who are pretty much new to this concept or, kind of unclear of what payback period is all about, I would urge you to look at a comprehensive video tutorial which we have created earlier. This covers, its calculations, formulas, its limitations and whatnot. Okay, so I would urge you to have a look at that first and then come to this discounted payback period. All right, so this video will start with an assumption that you know what is a payback period. All right. Okay, so let's take this example to understand what is a discounted payback period. Okay, let's assume that you have a project where you require some initial investments of, let's say, $1,200 in year 0. That's the initial investment. And this project yields $400 in year 1, $500 in year 2, $600 in year 3, and $700 in year 4. Okay, so this is like a typical project, okay, and no other expenses as such. All right, so how do we define first the payback period? Okay, we define payback period as the time taken to recover your initial investment, right? So it's a time taken to recover your initial investment. Okay, that is what is the payback period. Okay. Now, what is the initial investment? The initial investment is nothing but $1,200, and we would like to see how much time it takes to recover your initial investment. So if you look at the example here, in the first year you recover $400, another $500 in year 2, so you have recovered $900 by the end of year 2, right? But what about year 3? If you add this up again, that would be $1,500. So you have recovered more than your $1,200. So ideally, your payback period should come between year 2 and year 3, right? So let's calculate this more in a methodological way, and then we will contrast it with discounted payback period. Okay. So the first thing that we will need here is an item called as a cumulative cash flows. Okay. What is the meaning of cumulative cash flows? So we'll take it from the cash inflows point of view, that in the first year, we recovered $400. All right. What about the second year? The cumulative would be initial first year, cash flows of $400 and then another $500. All right. So we have recovered $900 by the end of year 2. And likewise, we continue for year 3 and year 4. So overall, this project yields a cumulative cash flow of $2,200. All right. Now, another thing that we need to know is the balance amount. What do you mean by balance amount? Balance amount is nothing but how much is still left to recover from our initial investment. So $1,200 was our initial investment and $400 is what we recovered. So the balance amount will be $800, right? To be recovered, correct? So that's what I'm putting that in the formula, $1,200 plus my $400 as a recovery. So the balance is $800 is yet to be recovered. Likewise, what is the balance after year 2? The balance is $300 to be recovered yet, because $900 cumulatively we have recovered by the end of year 2. 300 is still left. What about year 3? Now this goes into the positive, right? Because we have recovered more than the initial investment. So that is where our break-even point actually lies. So the way it is calculated is payback period. We have this as the negative balances. So this will be like 2 years plus something, right? So at the end of 2 years, you are yet to recover this $300, correct? So this will be 2 years plus some number, right? And that fraction amount is to be calculated by using this balance amount here, right? Now, you are earning $600 in year 3. And what is to be recovered yet? That is $300, right? So what will be the amount of time you take to recover $300? That will be nothing but the fraction of $300 divided by $600. So that comes out to be 0.5. Okay. So the overall payback period will be nothing but 2 plus your 0.5, that is 2.5 years. Okay. So this is how, payback period is calculated. Fairly simple. Now, look at what we have done right now. What's its biggest limitation? The biggest limitation is it doesn't consider time value of money. Okay. What do we mean by that? It is basically assuming that $400 which we get after 1 year is same as $400 that we have it today. Is that true? We know from time value of money concept that both have different value. So if we have to invest $400 today, it will have a far more value after year 1 and year 2 and so on and so forth because of inflation and interest rates, right? And in payback period, there is a complete disregard of this concept. So that is why what we do is we do a markup. We say that instead of using cash flows, let's use discounted cash flows. Okay. So we are saying that, okay, let's assume that here there was $400. Let's take a discounted cash flow instead of cash flows. And that would give us a better picture of how much is our payback period. Okay. So what is the value of $400 which we get after year 1? What is its value today? It will be the present value of $400, right? But in order to calculate the present value, what else do you need? You need the discount rate, okay? Or the rate of return that you expect, all right? So let's assume that the rate of return that is expected is, let's say, 10%, okay? So what is the discounted cash flow, okay? Instead of cash flows, remember, we are now going to use discounted cash flows. What is a discounted cash flow? Here it will be $400 divided by your 1 plus 10%. Okay, so I'm trying to find the present value of $400, right? And this is the amount of money that you're recovering in actuals because of time value of money concept. Okay, so 363.3 and not 400. Okay, so let's look at year 2. So I'll copy this formula and paste it, and instead of to the power of 1, I should have power of 2 because I'll get $500 at the end of year 2. So I have to discount it twice, right? So this will come out to be 413. And what about year 3? To the power of 3, this will be 450.8 and 478.1. So here I'm doing nothing, but I'm basically calculating the present value of these absolute cash flows. Now, once I have all of these, the approach to calculate the payback period remains exactly the same as we did earlier. So I'll just copy and paste this here. Okay. So instead of cumulative cash flows, I will make it as cumulative discounted cash flows. Okay. So cumulative cash flows on one side, here it will be discounted cash flows cumulatively. Okay, so let's do that. Cumulatively, first year, we recover 363.6. What about the second year? 363.6 plus 413.2. And we continue to the very end. So as you can see here, the profile looks slightly different, right? So by the end of year 3, you assume that you have recovered $1,500, but here in this case, you have recovered how much? 1227.8. Now, what's the balance amount? Let's calculate that too. Okay, so initial investment is $1,200 and we only recover 363.6. So the balance is 836.4. Okay, so I keep on doing it, and what we note is that again this number becomes positive between year 2 and year 3. So the discounted payback period comes out to be 2 years plus some fraction, right? Now look at this. We essentially are recovering $450 in year 3, and we have to recover 423.1 out of that. So how much time will it take? Obviously, it will be a fraction of both, right? So 423.1 divided by 450.8. So this will be how much? 0.9. So let me just increase the fraction. So this is 0.94. So the overall discounted payback period is 2.94 years. Okay. So just contrast this with what we got earlier when we calculated the payback period. It was 2.5 years. Now when we consider the discounted cash flows, the discounted payback period comes out to be a bit higher, and that is 2.94 years, right? And obviously it is accurate because this takes care of your time value of money, right? So this is how it's an upgrade over the payback period and addresses the limitation of just taking the absolute cash inflows over the payback period.
As we conclude today's discussion, a big thank you to everyone who tuned in from the Wall Street Mojo team. But hold on, the financial adventure continues. The next episode unfolds on Tuesday, and we're super excited about what's in store. Make sure to subscribe and turn on those notifications so you don't miss out on the financial insights coming your way. Until next time, this is the Wall Street Mojo team signing off. Stay informed, stay engaged, and stay Wall Street Mojo awesome.